Right. So today we're going to do a deep dive on something that I think a lot of you are going to find really interesting. We're going to be talking about creating passive income through ETFs.
Okay.
And our source material today is an article that we found from the Motley Fool.
Mm-hmm.
And the article is about an ETF called the Vanguard High Dividend Yield ETF, or VYM for short.
Okay.
And, you know, the Motley Fool's stated mission is to make the world smarter, happier, and richer. So I think this will fit right into that.
Right.
And the title of this article really caught my attention. The title is, Want Decades of Passive Income? Buy this ETF and hold it forever. Pretty bold claim. I don't know. What do you think about that?
Yeah, it definitely grabs your attention. And but yeah, it's a pretty big claim. So let's break it down. So first of all, what is VYM? VYM is an ETF. ETF stands for Exchange Traded Fund.
Okay.
And it's basically like a basket of stocks all bundled together. And when you buy VYM, you're basically buying a small piece of each of those stocks.
Oh, okay. So it's kind of like a one-stop shop for building a diversified portfolio.
Yeah.
Exactly.
Yeah, I like that. So what's unique about this specific ETF?
So VYM focuses on companies that pay high dividends,
Okay.
above average dividends. And the article really emphasizes a long-term buy and hold strategy.
Mm-hmm.
So the idea is you buy it and you just hold on to it for years and years, potentially decades.
Okay, so passive income, right?
Mm-hmm.
Something that's steady and reliable.
Exactly.
All right. So what about the companies within VYM? Are we talking about like risky startups, or are these like established players?
Actually, a lot of the top holdings in VYM are companies that you probably interact with on a daily basis.
Oh, really?
Yeah. So, for example, Broadcom, JPMorgan Chase, ExxonMobil, and even Walmart are all among the top holdings.
Interesting. So even though it's over 500 stocks in this ETF,
Right.
we're not just throwing darts at a board.
Right.
There's a strategy behind it.
Yeah, it's not just any 500 companies.
Okay.
They're specifically chosen because they have a history of paying these consistent and growing dividends.
Okay, so consistent dividend payers.
Sure.
Got it. So it is diversified, but it's not completely evenly spread, I guess.
Right, yeah. So the top 10 holdings make up about 26% of the ETF,
Okay.
which, is still diversified, but it's worth noting that those top 10 do hold a significant weight.
Mm-hmm.
And Broadcom, the top holding, actually represents 5.5% of the portfolio.
Okay.
So something to keep in mind.
Okay, so it is diversified, but not completely evenly spread.
Gotcha.
So if you're holding this ETF for years and years, potentially decades, wouldn't the fees kind of eat into your returns?
Well, that's one of the attractive things about VYM is that it has a very low expense ratio.
Okay.
Only 0.06%.
Okay.
So that means for every $10,000 you invest, you're only paying $6 per year in fees.
Wow. That's basically nothing.
Yeah, it's very low.
So it seems like they're really emphasizing keeping the cost down for the investor.
Right.
Okay, cool. So what about the potential for growth? Is this ETF just about dividends, or can it also appreciate in value over time?
So the article actually highlights both income and growth as potential benefits. It mentions the current dividend yield is 2.7%,
Okay.
which already sounds pretty good, and there's also a history of that dividend increasing.
And get this, over the past decade, this ETF has delivered average annual returns of 10.1%. That includes both price appreciation and those dividend payments.
Wow.
Now, I know past performance isn't a guarantee of future results, but still, it kind of paints an interesting picture of what's possible with this long-term investing strategy.
Oh, definitely.
Right.
Yeah, let's talk about the power of compounding for a second. Imagine you invest $10,000 in VYM today, and if it continues to grow at that historical rate of 10.1% per year.
In 10 years, you could be looking at almost $24,000.
Mm-hmm.
In 20 years, over $62,000.
And hold on, because this is where it gets really exciting. In 30 years, that initial $10,000 could potentially grow to nearly $163,000.
Yeah, that is pretty incredible.
Right.
So that's a pretty amazing return for just staying invested right.
Yeah.
But what if we take that a step further? Let's say on top of that initial $10,000, you decide to invest an extra $100 each month consistently.
Now we're talking some serious wealth building potential. So by adding that consistent monthly contribution, you could potentially end up with a portfolio worth over $345,000 after 30 years.
Wow. No, that's a game changer.
Right.
Really highlights the power of consistent long-term investing, even with relatively small monthly contributions.
Mm-hmm.
It's not about getting rich quick. It's about building a solid foundation for the future.
Exactly.
But before we get carried away with all these impressive figures, I think it's important to remember that.
Of course, past performance is never a guarantee of future results.
Exactly. The market is constantly changing, and there are always risks involved.
Right. However, VYM's history does show the potential of this long-term, consistent approach to investing, especially for those seeking both growth and a steady stream of passive income.
Okay.
So it's interesting to consider how this type of ETF could potentially fit into your own financial strategy.
Absolutely. It's not about blindly following any one article or strategy,
Right.
but about understanding what are the tools that are available and how they might align with your own goals and your own risk tolerance.
Right.
So what are your initial thoughts on VYM after unpacking all these details? What stands out to you?
Well, it's pretty fascinating to me that despite being heavily invested in the financial and energy sectors, which can be, susceptible to economic swings, VYM has shown this resilience and consistent returns over the past decade.
Okay.
So that raises an important question. So
Yeah.
as I was saying, it's pretty fascinating to me that VYM has managed to deliver such consistent returns, despite being heavily invested in sectors that can be a little volatile.
Right.
So it begs the question, how vulnerable is VYM to market downturns, especially considering that concentration in financials and energy?
Yeah, that's a great question. It's easy to get caught up in those impressive historical returns, but, we need to be realistic about the potential risks, too. I think the Motley Fool article actually touches on this a little bit. They remind us that diversification, while it's helpful, doesn't completely eliminate risk.
Right. And they point out that even those, rock solid big name companies within VYM can face challenges too.
Yeah.
Industries evolve, market conditions change, and, there's always the possibility of unforeseen events.
Right. So it's not just about picking an ETF and assuming it's going to be smooth sailing from there.
Exactly.
We need to be aware of those potential vulnerabilities and,
Right.
and understand how they might affect our investments. But how do we balance that awareness with the long-term perspective that's so crucial for success in the market?
Well, the article really emphasizes the importance of staying calm during those inevitable market storms. Remember, VYM is built for the long haul.
Mm-hmm.
So those short-term fluctuations shouldn't derail your overall strategy, especially if you're in it for, those decades of passive income potential.
So rather than panicking when things get choppy,
Yeah.
we should view those market dips as potential buying opportunities.
Exactly when prices drop, you have the chance to acquire more shares of those, high-quality dividend-paying companies at a discount.
Okay.
And this can significantly boost your long-term returns. Think of it like a sale at your favorite store.
Right.
Only this time you're buying, pieces of companies.
I like that analogy. It makes those market dips seem a little less scary and a lot more like strategic opportunities.
Exactly.
But this strategy of staying calm and buying during dips requires a certain level of trust in the market, doesn't it?
It does, but that trust is grounded in historical data. Time and time again, we've seen the market recover from downturns and reach new heights.
Okay, so it's about taking that historical perspective, understanding that market fluctuations are normal, and remembering that those dips can actually work in our favor if we have that long-term mindset.
Exactly.
But I'm curious how much of this success relies on simply choosing the right ETF versus actively managing our investments.
Well, the Motley Fool definitely leans towards that, buy and hold approach with VYM. They argue that trying to time the market or constantly adjusting your portfolio can actually work against you, especially in the long run. But there's a nuance to this that we should probably discuss.
Okay, I'm all ears. What's the catch?
Well, while they advocate for holding VYM for the long term, they also stress the importance of staying informed about the companies that you're invested in.
Okay.
So VYM isn't a static entity. It's a constantly evolving basket of stocks, and it's crucial to keep track of those changes.
So it's not a true set it and forget it scenario.
Right.
We need to keep tabs on what's happening within the ETF to make sure that it continues to align with our investment goals and risk tolerance. But that sounds like it could get pretty complicated.
It doesn't have to be. The Motley Fool actually offers a lot of resources and ongoing analysis to help investors stay updated on their holdings.
Yeah.
Think of it like having a team of experts providing insights and guidance along the way.
Okay, that sounds pretty helpful, especially for those of us who might not have the time or expertise to constantly monitor the market.
Right.
It's like having a personal financial advisor in your pocket.
In a way, yeah. But even with access to information and expert opinions, it's still crucial to, do your own research and understand the intricacies of what you're investing in.
Mm-hmm.
Knowledge is power, and that applies to every facet of investing.
I completely agree. And speaking of knowledge, there's another aspect of dividend investing that we haven't touched on yet. one that can have a significant impact on our overall returns.
You're talking about taxes, right?
Exactly, those pesky little details that can sometimes make or break a good investment strategy.
Yeah, The Motley Fool actually delves into this in their article, and it's something worth exploring further.
Okay.
Understanding the potential tax advantages or disadvantages of dividend investing can be crucial for maximizing your profits.
So we've talked about diversification, market volatility, and the importance of staying informed about our holdings. And now we're adding the tax implications to the mix.
Right.
It seems like there's a lot to consider when evaluating an ETF like VYM, even with its seemingly simple premise.
Absolutely. There's always more to learn, and that's what makes investing both challenging and rewarding.
Right.
It's about constantly expanding our knowledge, asking the right questions, and making informed decisions based on our individual circumstances and goals.
And sometimes it's about challenging those bold claims and digging a little deeper to uncover the nuances hidden beneath the surface. So with that in mind, let's transition to a crucial aspect of VYM, and any investment for that matter that we haven't fully addressed yet.
You're talking about the potential downsides, right?
Yeah.
Those risks that we need to be aware of before making any decisions.
Exactly. Let's flip the coin and explore the potential risks associated with VYM and how they might impact our quest for those coveted decades of passive income. Are you ready to dive into the less glamorous side of investing?
Absolutely. I always say a well-informed investor is a confident investor. Let's unpack those potential risks so you can decide if VYM truly aligns with your financial goals.
Right, so we've talked about the potential of VYM, its focus on those dividend-paying companies, the low fees, and even those impressive historical returns. But let's be honest, no investment is without risk. So let's dive into some of the potential downsides of VYM. Where do we even begin?
Well, we already touched upon VYM's heavy concentration in the financial and energy sectors.
Right.
And while these sectors can offer strong returns, they can also be particularly sensitive to economic downturns.
So even with the diversification of over 500 stocks, if those two sectors take a hit, VYM's value could potentially decline.
Yeah, that's a valid concern. It's essential to understand that sector concentration can introduce a level of risk. If those sectors underperform, it can drag down the overall performance of the ETF.
Okay, so sector concentration is definitely something to keep in mind. What other potential risks should we be aware of?
Well, market volatility is another factor that can't be ignored.
Right.
While VYM has demonstrated a history of solid returns, there's no guarantee that this trend will continue uninterrupted. Market fluctuations are inevitable, and VYM's value, like any investment, can go up and down.
That's a good point. It's easy to get caught up in the excitement of potential gains, but we need to be prepared for the possibility of downturns as well, especially if we're thinking about relying on VYM for passive income. Those market swings could be a bit unsettling.
Exactly, and that's why it's crucial to remember that VYM, and really any long-term investment, requires patience and a commitment to riding out those market fluctuations. Remember, as we discussed earlier, those dips can often present excellent buying opportunities.
Right. It's about staying disciplined and focused on the long-term goal rather than reacting emotionally to short-term market noise. But let's say we're comfortable with those risks. We've done our research, we understand the market, and we're in it for the long haul. Is there anything else we should be considering when it comes to VYM?
Well, one thing that often gets overlooked is the importance of staying informed about the companies within the ETF.
Okay.
VYM isn't a static collection of stocks.
Right.
Companies can evolve, industries can change, and what was once a strong dividend payer could potentially face challenges down the road.
So it's not just a set it and forget it kind of investment.
Right.
We need to be actively engaged, at least to some extent, in understanding the companies that make up VYM.
Precisely. It's about periodically reviewing VYM's holdings, keeping an eye on news and developments that might affect those companies, and ensuring that the ETF continues to align with your overall investment strategy and risk tolerance.
That makes a lot of sense. It's about being an informed investor, not just a passive bystander. It's about taking ownership of our financial decisions. But realistically, how much time and effort does this really require? It sounds like it could be a lot to keep track of.
It doesn't have to be overwhelming. There are resources available, like those provided by the Motley Fool, that can help investors stay updated on their holdings.
Okay.
They offer analysis, insights, and even recommendations to help you navigate the complexities of the market.
Okay, so it's about finding that balance between staying informed and not getting bogged down in the minutiae of daily market movements. It's about understanding the big picture and making sure our investments are aligned with our long-term goals.
Exactly. And that brings us back to the core message of that Motley Fool article. Want decades of passive income? Buy this ETF and hold it forever. It's a catchy headline, and VYM certainly has the potential to deliver on that promise. But it's crucial to approach any investment, even one as seemingly straightforward as VYM, with a healthy dose of realism and a commitment to ongoing learning.
So it's about understanding both the potential rewards and the potential risks. It's about asking the right questions, doing our research, and ultimately making informed decisions based on our individual circumstances and goals.
Precisely, and I think that's what makes this deep dive so valuable. We've explored not just the shiny surface of VYM, but also the intricacies and potential downsides. We've equipped you with the knowledge to make an informed decision about whether or not this ETF is right for you.
And at the end of the day, that's what matters most. Making empowered choices that align with our personal financial journeys. So as we wrap up this deep dive, we want to leave you with a final thought to ponder.
Regardless of which path you choose on your investment journey, remember that knowledge is power. The more you understand about the market, about the companies you're investing in, and about the various investment vehicles available, the better equipped you'll be to navigate the exciting world of finance.
So keep exploring, keep learning, and never stop asking questions. And remember, the journey to financial well-being is a marathon, not a sprint. Enjoy the ride.